Hey, hope you're all doing well out there. This is your October market review. So for those of you that are new to watching this video, the reason that I put these videos together each month is to give you the straightforward information with no media spin, political angle, or fear tactics that many media outlets use to get more viewers to watch their shows. My goal with this ultimately is to give you the straightforward information about what's going on in the stock market and the economy, and ultimately then how does that affect your investments. So stocks for the month of October hit new all-time highs across the board after about a 5% drop in September for major stocks. So the stock market indexes were up. S&P 500 up 7%, the NASDAQ 100, which is just the 100 largest companies within the NASDAQ. Generally, they're more technology-based companies. That was up about 10%. And then small cap stocks, which are smaller size publicly traded companies, were up about 6% overall. So the charts that I have for you this month kind of cover a few different areas here. The first area that I'll start out with is new home starts. So as you can see on this chart here, this chart goes back to 1990 and it shows both single family and multifamily new privately owned housing units started. So basically that's just new homes being built. And you can see in the 2007, 2008 timeframe with the big drop off with the financial crisis that was going on and the housing crisis that was going on at that point, and then the kind of subsequent rebound we've had here over the last decade. So I thought this was an interesting chart. And for those of you, I guess I'll take a step back here. For those of you that are newer to this video, the reason that I go over charts specifically is because I think that charts are the best way to show kind of pie in the sky sort of concepts, or wrap your mind around something that's an intangible sort of subject by putting a visual together like a chart. So that's why, I'll go over, I have 4 different charts here today that I'll go over with you. So those of you that are newer to watching these, I'll go through these charts, and the reason I use the charts is just as a vehicle to explain what I'm thinking is, how I feel of what's going on in the markets and the economy, and then ultimately ways that is affecting consumers and investors out there that are investing their money, because that's what we care about here at Client Focused, is your investment money. So I thought this was an interesting chart just because of the recent boom here in the last year that showed a big uptick in new homes being built during that COVID time frame, and then a little bit of a drop off since then. If we track it back though, that's really about the same spot that we're at in the mid 1990s as far as new homes being started, at least, or new home units being started. So it's not really where the demand is at though, because from 2009 through today, really, we haven't had a huge amount of new builds being constructed. So the largest demographic of people now is millennials, which are the generation really that came from the previously largest demographic, which were baby boomers. So the millennials are now at a spot where for years now they've been a little bit slower with doing the typical things like getting married, buying homes, doing all those natural progression things that typically generations in the past had done in their 20s or early 30s. Now is when the millennials are now coming around to doing that, and buying homes is just part of that. So there's a big demand for new homes being supplied out there, and there's just not the supply for it. So or a big demand for those out there, and there's just not the supply for it. So I thought this was a really interesting chart because one of the areas that is an overweight within a sector portfolio that we're using is the home construction fund, which is an area that takes advantage of new homes being constructed. So that was something I thought was interesting. It was something that I actually had just recently added that portfolio in August with a dip that the home construction sector was having, or at least the stocks were having at that point in time because of the Delta variant. So I think that will be a long-term trend, because we're going to see a lot of new home buyers, and it kind of goes into my next chart here that I have, which is the median sale price of existing homes. So these aren't new homes that are being sold. These are already homes that have been built and that are now being sold. The price for that is, getting close. The average at least is getting close to $350,000. The monthly number has crossed over the $350,000 mark, which this is the median home price. So obviously this just depends in your market. This may be higher or lower, just depending on where you're. If you're in Florida in St. Petersburg, you might be looking at $350,000 and that looks, super cheap, and you might be in a dodgy part of town if you're paying that. If you're in, some more rural areas of central Pennsylvania, or, you name the area where housing prices are a lot cheaper in the $250,000 or lower range, this may seem really high. Across the board, the numbers kind of all generally track the same. This is why it's the median price. So going back through 2000, you can see that since then, prices have more than doubled, which makes a lot of sense because of inflation. So inflation over time will push real estate prices higher as there's more and more, demand for those properties, and the just slow grind of the real estate market going higher. The big drop off there from 2007 through 2009, and then all the way, we've rebounded back well beyond that, and there's still more room to grow. I think that if we're looking at this chart, if you just kind of drew a line out from where we were in 2000 and we split the middle of that line, we're still probably below where housing prices would be if we were to just put a line right through where it was, and I'll do this in the video here, right where it was with the with the natural progression of a mean spot there. So probably still some more room to kind of go higher from here, and it's also a sign of a lot of equity that people have within their homes, which is a great thing for people improving their houses, and also just really feeling good about their overall personal finances, which that runs into a lot of other areas in their financial investment life. If people have more money or more equity within their house, they feel better or more secure financially because of that. They may take more risk as far as leaving a job to go get a better job and make more money. They may decide that they have money that's sitting in cash or savings in a checking account making nothing, and decide, well, now's the time to invest that. Or they may just feel like, well, we have the equity within the house, let's do some home renovations and improve on it even more to make it more to the standard that they want to live at. Lowe's and Home Depot are two stocks and two companies that have really seen the benefits of those people doing things like that. So I thought that was an interesting chart, and kind of goes with the bigger theme of housing and the boom within housing and people's net worths growing because of prices growing higher here with the demand for existing homes and new builds. So next chart that I have here gets more into the stock realm of things, getting away from real estate a little bit. That's what we're here for. I talk stocks. That's primarily what I'm doing. So the average real return in years with high inflation is the chart that we're looking at here. So this chart takes all the way going back through 1927. It takes years of high inflation, which we're in one of those right now. Inflation is 4.5%, 5%, depending on what metric you want to look at. And this shows the different areas that you can have money invested, from T-bills, which create negative or have negative returns over that time frame. T-bills are just short-term treasury notes that are generally very secure as far as the safety of it, and because it's backed by the federal government. But they're also, generally speaking, lower interest-bearing notes at the end of the day. There's then long-term government bonds. Those further out in duration, you have to hold those longer to get to the maturity. And then there's long-term corporate bonds, followed by equity markets, which would be stocks, manufacturing, energy, business equipment, telecom, so on and so forth, all the way down to where we hit our major segments that we're investing money through, which would be small cap growth stocks, small cap value, large cap growth, large cap value. So all of those areas, especially large or small cap value, you can see there, really outperform during high inflation years. The big fear is, well, what happens if inflation takes hold? Because a lot of you that are in your 60s plus can remember back into the 70s when there was stagflation and there was high interest rates, high inflation, and your money, if you left it sitting in a bank, you could make a good amount of money because interest rates were higher at that point. But your real rate of return was actually negative because inflation was a higher rate than what you were getting paid at the bank. Stocks were also a really good hedge at that point too, even though there was a lot of volatility in the stock market. Stocks over time generally are good inflation hedges, along with real estate. Gold typically, they say, is a good store of, or a good place to store money during inflation. Cryptocurrencies have now become, talked about as being a good store for value, although that hasn't really proven itself out yet because there hasn't been that many time frames that you can look at as far as how that's worked in inflation. Cryptocurrencies really haven't been around for much more than 10 years. Even if you're talking Bitcoin, Ethereum, the major cryptocurrencies that are tracked and talked about out there, there's not a big track record with them, so it's tough to really give a whole lot of weight to them being a great store of value just because there hasn't been a ton of time to work with. And even more recently, last year during the drop-off during COVID, they went just along with just like all other asset classes, dropped off the cliff. And really in the beginning part of this year when inflation had taken off, the major cryptocurrencies like Bitcoin, for instance, had not really done extremely well up until recently when it's just gone on a tear, more than doubling in the last handful of months. So there's still a lot more time that needs to go by for there to be some real reliable data to look at to see how cryptocurrencies really actually perform in different types of market environments. So off that rabbit trail, back onto what we were talking about. So small cap growth, small cap value, large cap growth, large cap value. As far as portfolios that I put together, that'll make up more or less the predominant portions of it, because you can break up different sectors like financial services, healthcare, utility, telecom. You could split those up into those different sectors and inside of those larger asset classes of large cap value and large cap growth there. So great spot for money to be held within a higher inflation environment. I thought it was an interesting chart to bring up and just show some different sectors that were as well. The last chart I have to go over here is a chart of the S&P 500 going all the way back through to the depths of 2009, at the very bottom of the financial crisis at that point, and fast forwarding all the way through today, where the index now is at around 4,600. So, really from the very beginning of this, where the index was at about 1,000 and it dropped well below that, we're more than 4 times where we were, a little over 12 years ago. So I thought that this was a really impactful chart to look at because we are at new all-time highs, and the fear that a lot of people have had, and I've seen this throughout my career over the last decade, is that when new all-time highs come, people think that that just means that markets are supposed to go down. What goes up must go down, like the laws of physics. And that's not necessarily the case with stocks. You can see here with new all-time highs, they've been followed eventually by new all-time highs. And over time, stocks do go higher, even, if we look at, decades where stocks did really terribly, like from 1999 or early 2000 through 2009, that was a really bad time frame to have invested in the stock market. So over the last 12 years, completely opposite. So, and there'll be different cycles that go on. There's always recessions and other things that happen. But I thought that this was an interesting chart just because it does show those all-time highs. And if you track back to even like 2014, where it seemed like we were peaking out at that point, like the market didn't have anywhere to go and it dropped off at different points at the end of 2015 and beginning of 2016. Those were drops of about, 10, 15% at least at those points, which seemed like, oh, the market's going down. It's over. The economy is really bad. Things are going bad. And then what happened then? Yeah, if you held on in 2016, is that about 6 months later there was a new all-time high. So we're going to go through those drop-offs. We haven't really had one. The September 5% pullback was like a blip on the radar that was quickly erased here in October. There's going to be bigger ones where the market drops off 10, 15%. But again, I wanted to bring this chart up to show you kind of the track record of the more recent cycle that we're in and where all-time highs have led us. The next round of in-person investment reviews that I'm doing for my Pennsylvania clients here is coming up in December. I'll be reaching out to each of you that I didn't meet with in September for those reviews. If we met last in June, you're probably likely up for me to reach out to you here in December or before December to do a review in December. So you'll hear from me here over the next couple weeks to set those up. If you don't hear from me or you just like to get on the calendar ahead of time, feel free to give me a call here. I'd be happy to link up with you and make sure that we get you scheduled for a December review. If you prefer doing a Zoom meeting, very flexible this month, throughout the month, or at least the beginning part before Thanksgiving, which is crazy that Thanksgiving's coming up already, but I'm very flexible to do Zoom meetings, and I'll be happy to do that with you if you'd like to go over your specific accounts or portfolio. If you have any questions or need anything from me, please don't hesitate to just call, text, email. More than happy to help. If you have any friends, family members, coworkers, or just someone you think would be interested in having a conversation with me about their investments, please feel free to give them my information. If they prefer me reaching out to them, get them my information. I'd be more than happy to reach out to them and have a conversation with them at that point. I appreciate you all taking the time to check me out. Until next time.